What is up, everybody? Welcome back to the stocktrades.ca YouTube channel. My name is Dan Kent, one of the co-founders of stocktrades.ca, and this week we're going to get back to our 2020 year in review. Last week, Matt took a break from this review to discuss a couple stocks in Canada that are going to raise dividends in December, at least stocks that we think are going to raise dividends. If you want to see that, I will drop a link above. But this week, we're going to go over 5 of the top performing consumer defensive stocks or consumer staple stocks here in Canada. And normally you'd be able to predict what is on this list, but I guarantee you, you are not going to expect the stocks, the top performing stocks in this sector, to be what they are this year. So with that being said, let's get started. 5 of the top performing consumer staple stocks of 2020. So most importantly, before we get started, again, if we hit 10,000 subscribers before December 31st, we're going to give away over $1,250 in premium memberships. If you're not aware what Stock Trades Premium is, stock screeners, stock picks, model portfolios, a Q&A section with over 1,000 questions and answers. It is the best platform for Canadian investors, and we're going to give away a ton of memberships for free if we just hit 10,000 subscribers. A consumer staple stock is essentially just something that is considered a staple. So any company that sells something like food would be considered a consumer staple. Any company that focuses on beverages would be considered a consumer staple. So with this list of top performing consumer staple stocks in 2020, I was actually surprised myself to see that this list is dominated by smaller cap stocks in very niche markets, like say seafood or plant-based foods. So this was actually one of my favorite videos to do. And again, there's no ranking to this in order of preference. All I've done is taken the 5th best performing and gone up to the best performing of 2020. And with that being said, let's get into the first stock on this list. And that is actually one you know about, which is Dollarama. They trade under the ticker DOL. So in terms of returns in 2020, as we can see by the chart, Dollarama has returned around 18.6%. This is significantly higher than the 1.4% the TSX has returned. And we can see, interestingly enough, back in March, Dollarama seemed to crash prior to the TSX. But then after the TSX started crashing due to COVID-19, Dollarama lost around 20% at its bottom, while the TSX, as you can see, is in the 35% range. So this stock is something that held on quite well during the crash, and it quickly started recovering at a faster pace than the index. And if we extend this chart out to a 5-year period, we can see that Dollarama's had a pretty rocky 5 years in terms of share price. This has been a popular growth stock among Canadians, but unfortunately, growth has slowed. And the stock was fairly overvalued for quite some time compared to its forward-moving growth rates. But don't get me wrong, this is still an excellent consumer staple option, and Dollarama actually does still have some growth in it. It just isn't the high-flying growth stock that it has been over the past while. So as of the company's recent quarterly report, they have around 1,314 stores, and each store has annual sales of around $3 million. 50% of their merchandise is sourced directly from over 25 countries, obviously primarily China, and they do this to essentially reduce costs. And as we can see by this chart, just under 900 of its 1,314 stores are located in Ontario and Quebec. And you can see that compared to other dollar stores here in Canada, there is almost next to nobody who is growing at the pace Dollarama is. And in terms of pure play dollar stores, Dollarama is 5.7 times larger than its next pure play competitor. This gives the company a significant advantage in the dollar store market. I mean, when you're that much bigger than your competitor and you're expanding at the pace that they are, it's ultimately going to get you into more small towns, more cities, things like that for cheaper. So most of Dollarama's goods are just general merchandise, but they do sell a lot of consumables, which are essentially recurring purchases that a lot of customers make, which is a good thing. And of course, 16% comes from seasonal, Christmas, Halloween, gardening, stuff like that. And the thing about a company like Dollarama is when times get tough, like we're seeing this year, people are going to abandon more expensive stores. And in the case of Dollarama, even a store like Walmart is considered expensive. I mean, I've shopped at both, and the stuff that Dollarama sells is insanely cheap. And for somebody who's looking to pinch pennies in the COVID era or the post-COVID era due to a lack of capital or a lack of a job, they're gonna shop at cheaper stores like Dollarama. So this is a company that's going to be able to weather any type of economic situation, and it's shown to do so in the past. And this is one of the primary reasons that it's outperformed the TSX in 2020 and has actually posted larger returns than other defensive stocks like Loblaws and Metro, who don't even make this list. So in terms of valuation, the company is trading at around 26 times forward earnings, which is actually a 4% premium to what it has typically traded at over the last 5 years, which is appropriate considering the state we're in 2020. And the company is actually trading right in line with its average price to sales at 4.2. So the issue I see with Dollarama right now is analysts figured that this company will grow revenue by 10 to 14% next year and earnings by relatively the same mark, low double digits. But the company's trading at 26 times forward earnings. So this is a pretty expensive price to pay for a company that's only growing its top and bottom lines by just over 10%. And keep in mind, these are just estimates. I mean, they could do more than this or they could do less. But there is no question that Dollarama's growth has been slowing over the years. And this is exactly why it's become not as popular of an option for Canadians. So valuation is definitely something to keep in mind. And the reason it is this high is likely because of its outperformance in 2020. So moving on to the next stock, the fourth best performing consumer staple stock of 2020 is a very unknown company called the Northwest Company. They trade under the ticker NWC.TO on the TSX. And if we look at its year-to-date chart, the company has returned around 26.3%, while the TSX has returned just 1.4%. This is a pretty significant outperformance, and the stock started to outperform right as the market started to recover from the March crash. If we extend this out to a 5-year period, this is a company that has maintained its outperformance of the TSX. But as we can see, for the most part, this is a company that kept right in line with the TSX's returns. So the Northwest Company is actually a pretty interesting grocer. They primarily serve essentially retail markets that a lot of grocers don't reach. Think of Northwest Territories, Nunavut, Alaska, Hawaii. The company even states it serves consumers 8,500 miles east into the Caribbean islands. This is a very niche specialty company. This is also a very old company. It's been around since the late 1600s. And they typically, at least in their northern regions, provide things like clothing, groceries, hygienic products to very small communities, often 500 to 8,000 people in population. So why has this company performed so well in 2020? You know, this small cap grocer that typically appeals to regions that are relatively unknown when it comes to investors looking for defensive style stocks. Well, the company has grown its revenue at a pretty rapid clip. If we look to second quarter earnings, which are back to the peak of the pandemic, the company reported revenue of just under $650 million, which is a pretty drastic increase from the $527 million it posted in the second quarter of 2019. We can see EBITDA essentially doubled and its net earnings more than tripled. The Northwest Company had a crazy second quarter, and actually I hadn't paid attention to the company much until this video, and I was actually really impressed with how they performed throughout the year. So why was the company not only able to keep its revenue the same, but increase it and drive higher profits? Well, that's because the vast majority of its sales come from essential goods. Sales that essentially are going to remain untouched regardless of the pandemic we're going through. So the company has a high essential product and service retail sales blend. The company states that 91% of sales are an essential product, and essentially all of its stores remained open during the peak of the pandemic. A drastic drop in travel meant higher local retail demand. The company is in extremely good financial shape. As we can see here, they have a debt to equity of less than 1, and they've maintained this ratio since 2000. This is essentially 20 plus years of wise, prudent debt management. They have 190 million in capacity on existing credit facilities, and the company is looking to reduce capex in 2020 to the $65 million range to essentially preserve cash. Overall, this is a very interesting company, and one that I definitely looked at but never really paid attention to, and I kind of wish I did. In terms of valuation, they're trading at around a 10% discount to their average forward price to earnings and are essentially right in line with their historical price to sales. Analysts don't see much upside in today's price levels, maybe due to the run-up they've had in 2020, and they essentially expect flat earnings and revenue growth. But let's move on to our third best performing consumer defensive stock in 2020, and that is Highliner Foods. They trade under the ticker HLF on the TSX. So if we look at Highliner Foods chart, we can see that they are outperforming by quite a large margin. They've returned 40% this year, while the TSX has returned 1.4%. But if we extend this out to a 5-year period, we can see that Highliner Foods has underperformed the TSX by quite a wide margin. And in fact, this has generally been quite a poor investment since essentially mid-2017. So interestingly enough, I'm actually not a fan of this company at all. Highliner Foods has struggled quite a bit over the years, and if we look to its most recent quarterly report, we can see that sales are actually down year over year. Gross profit is down year over year. Adjusted EBITDA and adjusted net income are up, which is a good thing. But overall, the company has been, in their own words themselves, you can see at the bottom of this page, severely impacted by COVID-19 and may continue to be impacted in future periods. So dropping revenue and dropping earnings is not exactly unique to 2020 for Highliner Foods. Revenue essentially is flat over the last 4 years, and essentially earnings have caved. This company is struggling to drive growth in its bottom line. So why exactly is Highliner Foods up 40%? Like, why is this, in my opinion, poor company up 40% year to date? Why is it outperforming a company like the Northwest and Dollarama? Well, you have to look to a key event that happened to actually the next stock on this list. So in early November, Clearwater Seafoods, which, spoiler alert, is the next stock on this list, was acquired by Premium Brand Holdings. This happened on November 10th. And Clearwater Seafoods is essentially Highliner Foods, one of their primary competition. And if we look to the 1 month chart here comparing Highliner Foods to Clearwater, we can see that right around this November 10th mark is really when Highliner Foods takes off. When there's noise of this acquisition, we can see that prior to the acquisition, the company was up around 7-8%. And after the news of the acquisition, it shot up to around, just under 35% gains. So this is a company, this is a stock that has benefited immensely from the acquisition of Clearwater. As a result, it is a stock that is trading at somewhat of a premium right now. Highliner Foods does pay a dividend. It's around 2.48%, and the dividend is actually very well covered by trailing earnings with a payout ratio of only 27%. But moving forward, even though this is one of the best performing consumer staple stocks of 2020, I would not be touching Highliner Foods. Haven't been a big fan of them and likely won't be moving forward. But anyways, let's get on to our second best performing stock, and one that is the second best performing, no doubt, because of an acquisition, and that is Clearwater Seafood. They trade under the ticker CLR on the TSX. So yes, Clearwater Seafoods has been acquired, which has been a decent chunk of the company's outperformance in 2020. But the fact is, this company started outperforming essentially right after the crash. If we look to its year-to-date chart, Clearwater is up around 43.3%, while the TSX has gained around 1.4%. So essentially, I'm not going to waste my time speaking on a company that's been acquired. Obviously, you would be more interested in learning about the acquired company, which is Premium Brand Holdings. And this is actually a stock that we've really liked over at Premium for quite some time. It was a 2019 highlight by us to Stock Trades Premium members. And this is kind of a niche play on a grocer. It hasn't performed that well in 2020 due to the fact that it's more of a growth play and a specialty grocer play. So essentially, when the economy gets hit as hard as it has in 2020, the brands that Premium Brand Holdings has aren't going to perform as well as, say, a company like Loblaws or Dollarama, who sells cheap goods. I think Clearwater Seafood speaks to this perfectly. Seafood is not something that people who are trying to pinch pennies are going to go out and buy. And as we can see by this image, Premium Brand Holdings, you don't see any discount brands in this company's arsenal. These are typically niche stores. They have lower volume, so they can't cut margins as much as a major retailer like Empire, like Loblaws can. Those who own Clearwater before all this acquisition news, depending on when you've bought it, you may have done quite well. I mean, this is a very niche small cap stock. It's not one that a lot of people paid attention to. But Premium Brands is essentially going to purchase it, merge it into the other plethora of different types of stores it owns, and Premium Brands, like it does with a lot of other acquisitions, will likely be able to make this a profitable endeavor. But let's move on to our number one performing consumer staple stock in 2020, and this stock has absolutely exploded this year, and that is Sunopta. They trade under the ticker SOY on the TSX. So before we get into what Sunopta does, let's have a look at 2020 performance. And as you can see by this chart, the company has soared in 2020. Essentially, right after the market crashed, this company started taking off in a big way. And as we sit, it sits with a 307% return compared to 1.4% of the TSX. So what exactly is Sunopta? Well, they are essentially a leading global company focused on plant-based foods and beverages, fruit-based food and beverages, and organic ingredient sourcing and production. So this is essentially a pure play for things like non-GMO organic foods, which, whether you agree with it or not, is catching on in a big way in 2020. So the company operates in three primary business segments. That would be plant-based foods and beverages, fruit-based food and beverages, and global ingredients. They had $1.2 billion in fiscal 2019 revenue, and the company has actually grown its adjusted EBITDA at quite a decent clip, going from $8.2 million in the fourth quarter of 2019 to just under $23 million in the third quarter of 2020. So the company states that the organic food and beverage market is expected to grow nearly 15% over the next 5 years. So obviously, if you believe in this type of growth, Sunopta, being a pure play organic and non-GMO company, would be a good play in this industry. So another concept, huge concept in 2020, especially as more millennials enter the stock market, is socially responsible investing. Again, whether or not you believe in it, it is crucial moving forward, and Sunopta is a company who is putting things like animal welfare and the environment first. So plant-based eating is obviously growing in popularity, and as it says here, 85% of millennials say it's extremely important or very important to them that the companies implement programs to improve the environment. So this is a relatively unknown company, but it does deal with a pretty big group of customers and ones that are very well known. If we look to this image, we can see that the company actually has some pretty big clients. We can see names like Costco, Starbucks. We can see companies in the United States like Sonic, like Sam's Club. These are some pretty big clients, and they're actually clients that aren't just based in Canada. So now that we know what Sunopta does, let's move towards valuation. And it's really key to understand that this company is trading at a pretty hefty premium right now. In terms of forward price to earnings, it's trading at over 100 times earnings. And in terms of price to sales, it's trading at a over 100% premium of what it typically has traded at over the last 5 years. This is a company that is not yet profitable. Analysts expect it to be profitable in 2021. But this is also a company that analysts feel are only going to be able to drive top line revenue growth by around 15% next year. The company posted a earnings per share loss of around 37 cents in 2019. And in 2021, analysts actually expect the company to earn around 13 cents a share. So this is a pretty drastic improvement on earnings. I just believe right now this company has a pretty expensive price tag, especially due to its recent run-up. Sunopta overall is an environmentally friendly company, which is huge moving forward, and it does have a lot of capability bringing more production online to drive future growth. It's just in my opinion, the stock is riding a ton of momentum right now, and just understand that you are paying right now a lot for future growth. That's always something you need to understand when purchasing a stock. But there's no questioning that it has been the best consumer staple stock in Canada by a massive margin. And I'll be keeping an eye on the company moving forward to see how it does grow. But overall, that's it for the video. The 5 best consumer staple stocks in the country in terms of performance. The number 3 and number 2 stocks, Highliner Foods and Clearwater Seafood, essentially benefited from an acquisition, but performance is performance, and we vowed to keep these videos based solely on performance. Dollarama is always a strong option for those looking for a defensive play. The Northwest Company is a very interesting stock. In fact, it's probably, to me, the most interesting stock on this list. It has, behind the scenes, essentially driven very strong growth in the COVID-19 era. If you like the video now, smash that like button, and most importantly, let's get us to 10,000 subscribers by the end of the year. It looks like we're gonna fall short of this number, but all you need to do to help us hit that number, and we don't need much of a boost, smash that subscribe button. Stay tuned for next week's video where we go over the top performing gold stocks of 2020 as we continue our 2020 in review. As always, till next time.